Hello everyone, I'm John with JP Strategic Investments, and today I'm going to go over the two main types of stock analysis that investors and traders use, and which one you should use based on your stock market strategy. If you enjoy videos like this, as well as stock-specific analysis and earnings reviews, be sure to like and subscribe so you don't miss any of my latest analysis. And with that said, let's dive right in. So first of all, the two types of analysis I'm going to cover here are fundamental analysis and technical analysis. These are the two main ways investors and traders analyze stocks and determine when to buy and sell. So let's quickly go over what each one entails, and then I'll walk you through which strategies they work best with and why. So fundamental analysis, often abbreviated FA, is a method of measuring a stock's intrinsic value by examining related economic and financial factors. So in other words, fundamental analysis looks at the fundamentals of the company and any other outside factors that could affect the business. Investors who focus on fundamental analysis will look at things like financial data, how much revenue and profit the company is bringing in, are the company's sales growing, and a variety of other things like this. The goal of this analysis is to determine whether or not the company's stock is undervalued or overvalued based on the company's fundamentals. So for example, if I wanted to analyze Tesla using fundamental analysis, some of the things I would look at would be their financials. I'd look at their delivery numbers and make sure that they're growing. I'd look at their margins and what their competitors are doing. And then I'd look at their future plans and how likely I think it is that they'll be able to execute on those. And then based on that, I could determine where I think Tesla will be in the next 3 to 5 years, or however far I'm looking out, and then I could figure out whether or not the stock is a good buy based on that. Technical analysis, on the other hand, which is often abbreviated TA, does not focus on the company at all, but instead uses the stock's previous price action to predict future movements. Traders who use technical analysis will often look at a stock's chart and other data including trading volume, price action, and historical trends to predict the future movements of stocks. Indicators that are often used by traders who use technical analysis include moving averages, RSI, and support and resistance. These indicators, along with the data that I previously mentioned, help these traders to determine what the market sentiment is for the stock and allow them to make educated predictions as to where the stock will go next. So again, if I were to analyze Tesla, but this time using technical analysis, I would do a variety of things depending on my specific trading strategy. I could look at levels of support and resistance, check the RSI to see if the stock is overbought or oversold, look at previous patterns in the stock's movement, and a variety of other indicators, and then based on that I could determine specific points to buy or sell the stock. So now that you have an idea of what each type of analysis entails, let's go through some different investing and trading strategies and see which type of analysis works best for each one. One strategy that traders can use is day trading. Day trading is a strategy that involves buying and selling stocks, options, or other securities within the same day. Often day traders will buy and sell a stock over the course of minutes or hours. This is very alluring for many new traders because of the potential for making large amounts of money in very short periods of time, but it's also easy to lose a lot of money if you're not careful. If you plan on day trading, then you should absolutely use technical analysis. This is because most of the trading that occurs in the middle of a trading day has not a lot to do with the actual fundamentals of the company, unless important news comes out in the middle of the day. Other than that, the stock tends to trade mostly on their technicals throughout the trading day. Day traders can use this technical analysis to find trends and patterns in a stock that can help them determine what type of trading is occurring with the stock and where the stock is likely to go next. Once a trader has identified a pattern, they can determine when to buy or sell. Here's an example of this. One of the most basic concepts of technical analysis is support and resistance. Looking at this chart, for example, we can see that this stock seems to be moving in a slight upward channel, with the lower blue line here being support and the upper blue line being resistance. We can see that the stock has bounced up and down off of these lines multiple times, confirming this support and resistance. If a trader notices this, one strategy they can use is to buy the stock or a call option when they see the stock starting to bounce off of the lower support line. Then they can take their profits when it gets near the upper resistance line. They could even buy put options or short the stock as it bounces down off of the upper resistance line and make money both ways as the stock moves up and down between the two lines. Once the stock eventually breaks out of this channel, the trader can then move on to another stock or look for a new pattern emerging. Now, let's say you're the opposite of a day trader. Instead, you want to focus on long-term investing and saving for retirement. If that's the case, then you should mostly focus on fundamental analysis. This will allow you to analyze the current value of companies and determine how much growth you think companies have ahead of them over the next 3 to 5 or even 10 years. Then based on that, you can look at the current stock price and see if the stock is already pricing in that growth or if the stock is undervalued. Over the long term, fundamentals of a company and the economy surrounding them will always outweigh any technicals in the stock. If a company unexpectedly triples their profits over the course of the next 2 years and sees more growth ahead, then it doesn't matter what the technicals are showing, the stock will have to move up to price in the increase in profits. For investors using a short to medium term strategy, I would recommend using a mix of fundamental and technical analysis. If you tend to trade more over the course of weeks or months, then maybe lean more towards technical analysis. But if you're investing for a few months to a year, then maybe lean more towards fundamentals. Either way, if you're not day trading or investing for very long periods of time, then you will likely have to use both types of analysis. Even traders that are only in stocks for a week or two will need to be aware of things like earnings reports and other fundamental news that could come out and disrupt the technical analysis. On the other hand, investors that are in a stock for a period of months to a year should also be aware of the technicals, especially when it comes to support and resistance levels, because these can be key in determining entry and exit points, even when relying mostly on fundamental analysis. So the main idea here is that both types of analysis are valid ways to go about investing and trading, and depending on your specific strategy, you should adjust how you use each of them to meet your needs. I hope you found this analysis helpful, and if you did, please consider liking and subscribing for more stock analysis and other videos like this. Leave me a comment below if you have any questions or any ideas for future videos, and other than that, have a great day.